Welcome back to the channel. I have another banger for you guys today. Tom Lee was on CNBC and had a lot to say about inflation and how it's falling like a rock. He also talked about the Federal Reserve and what will happen to the markets if Trump wins or if Biden wins the election in November. So Tom Lee is a former chief equity strategist from JP Morgan Chase. He also has his own research firm called FundStrat, where he provides research to hedge funds and individual investors. He has a lot of credibility in the investing space and has been right a lot more time than he has been wrong.
With our friend Tom Lee, FundStrat managing partner and head of research, also a CNBC contributor. Tom, what's that refrain that the cool people on the interwebs like to say, elections have consequences? Well, they certainly have, at least in those markets. Do you see a risk here?
Well, I do think that there is a risk that there is a conservative wave in November. Not that I consider that a risk to markets. I think that unlike Europe, I think that the U.S. stock market is not going to be flummoxed by a change in parties in the White House or in Congress. And one reason for that is, well, one, history just show that regardless of outcomes, equities generally do pretty well post-election. But also, I think that there are maybe sectoral implications for changes in the party, but not for the economy sort of as a whole.
Yeah, that's fascinating. And you wonder if it's because, without diving into politics, Tom, I wouldn't ask you to do that. But let's be clear. From an economic policy perspective, the current guy and the former guy, when it comes to trade and stuff like that, are pretty much the same.
That's right. I'd say when it comes to sort of global trade and sort of global dynamics, they're very similar. I think the differences come with regard to things like energy policy, where I think if Trump, it wins in November, it's actually bad for energy stocks because there'd be more drilling. And I think if Trump wins in November, that it would actually be good for Bitcoin. So in some ways, watching Bitcoin and energy give you some sense for how the market is sort of judging outcomes.
And if Biden wins, it's probably just kind of more of the usual, because we have him in office now and we see what's going on.
That's right. I think that if Biden wins is that you would just have continued gridlock and potentially maybe liberal fiscal spending. And so it's not a terrible dynamic for markets. And as long as inflation doesn't re-accelerate, it doesn't make the Fed's job any harder.
Just to clarify, Tom Lee said if Biden wins the election, things will continue to be the same. But if Trump wins the election, the energy sector might move lower due to more drilling. And Bitcoin will move higher since Trump is very crypto friendly. Now let's take a look at what Tom Lee had to say about inflation and how that will affect the markets.
Well, a beautiful transition from Tom Lee to Tom Lee, because inflation was the topic of your big investor note today. And you said inflation seems to be falling like a rock. Why do you say that? And is that necessarily good news for stocks?
Well, the reason we said that is there seems to be some skepticism from our clients about the quality of that May CPI report, which came out Wednesday, and the May PPI report, which came out Thursday, because it was such an abrupt decline in the rate of inflation from April to May. But the internals were actually much better than people realize. Over 55% of CPI components are now below their pre-pandemic average. That means a lot of the sort of drivers for inflation are actually falling away. And in terms of what it means for markets, you're right. You don't want to be in a deflationary scenario, which it's really not happening. Inflation is still in the high twos, but it's moving faster towards the target than the Fed realizes. That actually is somewhat constructive.
Well, can you blame your clients from wanting to see maybe a couple of months of proof? Because every jobs number has been basically revised the other way. You get all this crazy, noisy data between the employment survey and the household survey. Nobody can seem to figure it out. I don't think it's a bad thing to get a couple months confirmation rather than get all joyful because, used car prices might have fallen a little bit.
Yeah, that's a great point. I think one thing that maybe investors are starting to have some tension with is this idea of data dependence, because, markets want policymakers to be somewhat forward-looking. And the idea that we're just looking at these backwards inflation reports and then judging what inflation's doing, it does create a lot of tension and obviously a lot of uncertainty in bond markets. That's why rates markets have really had a hard time making heads or tails of this.
Just to clarify, Tommy mentioned 55% of the components that's measured in the CPI inflation report is below their pre-pandemic average, which is a good sign that inflation is coming down and will be moving towards the Federal Reserve target of 2%. And this might happen sooner than we think. And this will allow the Federal Reserve to lower interest rates very soon.
I posted this to X. Tom, I don't know if you had a chance to see it before you came on, and I was just showing the divergence between the Dow and the NASDAQ. I know nobody cares about the Dow. It's just more like a media index. But the way the NASDAQ keeps going up, the Dow is actually down recently. Over half its stocks are down in the past 3 months. There's the chart. Thank you, guys. And actually 273 of the S&P 500 are actually lower over the last 90 days, Tom, even as we make record highs. Are you worried at all about just this? I know we've talked about it before, but this massive concentration at the top and so many companies that are just not participating?
Well, yeah, I think it's probably one of the sort of fly in the ointments, or one of the things that's getting investors nervous is that it would be better to see better breadth. And of course, I'd love to see the Dow keeping up with the NASDAQ. I think part of this is that monetary policy sort of having hawkish pauses, and the idea that the Fed, is still keeping on the table the potential for hikes, means it's really hard for stocks to break out, because at the end of the day, CEOs have to say, well, if the Fed's going to be raising rates, I'm going to stay cautious, and that's what's keeping stocks cautious.
Let me know what you guys think about this take in the comment section down below. Please like and subscribe. Don't forget to get some free stocks in the description down below with Mumu, who is a sponsor of the channel.